Good afternoon. I'm Matt Blume from Pekin Hardy Strauss, and I'm here with Josh Strauss. And we're here today to provide a little bit of color on this quarter's investment commentary, which is about the jittery state of the Treasury market. Since August 2020, investment returns on Treasuries with maturities greater than 20 years have been absolutely horrendous. The losses are actually on par with the losses that equities had during the global financial crisis, which is eye-catching to say the least. So, Josh, any thoughts on the losses here?
Hi, Matt. Sure, of course. We highlighted in January 2021 in our investment commentary the rising risks in the bond market. At that time, the 10-year Treasury, the yield had bottomed August 2020, actually, at a 0.5% yield to maturity. Roughly 17 trillion with a T in bonds across the world were trading with a nominal negative yield to maturity. And over the last 2.5 years, short and long-term interest rates have been rising, decimating investors who own the long end of the yield curve.
Yeah, well, it was pretty hard to be excited about bonds at that point in time. But so what is causing the volatility that we're seeing right now in the bond market today?
The colossal federal deficit is pressuring investors' ability and/or willingness to absorb the enormous and rising Treasury bond issuances that are taking place. Mm-hmm. Foreigners owned about a third of U.S. Treasuries, and demand for those investors has waned, particularly so from Japan and China. Another big U.S. Treasury holder, the Federal Reserve, has been steadily selling off its holdings at a pace of about $60 billion a month, on top of another $35 billion a month in mortgage-backed securities. At the same time, the federal government is running a significant $2 trillion deficit. The Department of Treasury is on a borrowing binge, raising $1.7 trillion thus far this year, which is up roughly 80% relative to 2020. In summary, the recent volatile and upward moves in interest rates mean that the immense size of the U.S. deficit and its troubling trajectory are finally starting to matter.
But so why is it finally mattering today, right? Now, why now after all this time?
Yeah, that's true, because historically investors said it didn't really matter given the fact that we own our printing presses. But it has a lot to do with recent financing of treasuries. Nearly a third of Treasury debt will be refinanced with an interest cost of close to 0 to 5 to 6% in the next 12 months. Interest expenses relative to federal outlays have nearly doubled year over year from 2022 to 23. And the trajectory for debt to GDP is just terrible.
No doubt. So is there anything that we can do about it?
Well, truth be told, the likeliest scenario is that the federal government will once again kick the can down the road.
Yeah.
All options for reducing debt relative to GDP are painful. No politician who wants to keep their job wants to cut Medicare, Medicaid, Social Security entitlement programs. Defense spending is not likely to slow, given the fact that the U.S. has embroiled itself in the Middle East and Ukraine and is also funding money towards Taiwan. Increased income taxation is unlikely in the near term for a variety of reasons. Thus, the most politically palatable and realistic scenario is continued inflation to lower the future value of the U.S. debt burden and associated interest costs. Even in the face of that inflation, we think that the Federal Reserve will be forced to use both conventional and unconventional tools to bring interest expenses down for the government.
Wow, it's fascinating, and I can't wait to read more about it. And you can read more about it at www.pekinhardy.com. Have a terrific day. Thanks.
Thank you.